If a company made over $2 billion in profit last year, has grown its dividend for 6 straight years in a row, and analysts are projecting nearly 60% upside, why has its stock still fallen almost 30%? Something doesn't add up. Stick around, because by the time we go through Vistra Corporation's numbers together, you'll see exactly where that disconnect is coming from. Let's start with the size of this company. Vistra currently carries a market cap, meaning the total value of all its shares combined, of $46.63 billion, but its enterprise value, which adds in the company's debt and subtracts its cash, jumps up to $66.71 billion. That gap between the two numbers is our first clue that something bigger is going on underneath the hood. Over the last 12 months, Vistra generated revenue of $19.21 billion, and after every expense and tax was paid, the company kept the $2.03 billion in net income, working out to earnings per share of $5.87. At first glance, that sounds like a steady, profitable business, but here's where things get interesting. The stock trades at a trailing price-to-earnings ratio, or PE ratio, of 23.68, meaning investors are paying about $23.68 for every $1 of past earnings. Yet the forward PE ratio, based on expected future earnings, falls all the way down to 13.57. That is a massive drop, and it usually means the market is betting on serious earnings growth ahead. And that's not even the most surprising part. Vistra's PEG ratio, which weighs its valuation against its expected growth rate, sits at just 0.39. As a general rule, anything under 1 is considered a sign that a stock might be inexpensive relative to how fast it's expected to grow. A number this low tends to make investors pay close attention, but before jumping to conclusions, look at who actually owns this stock. Institutions, meaning large funds and firms, hold 85.58% of Vistra's shares, while company insiders hold only about 1.1%. The total float, or the number of shares actually available for public trading, sits at 312.89 million out of 335.64 million shares outstanding. That share count has barely moved, up 0.45% over the past year and actually down 0.77% from the prior quarter. This is a stock almost entirely in the hands of big institutional money, not one being flooded with new shares. Now here's where investors often get confused of what's really driving Vistra's numbers. Look at the balance sheet. The company is holding $20,510 million in total debt against just $435 million in cash. That leaves a net cash position of negative $20.07 billion, or negative $59.81 per share. In plain terms, for every share of Vistra you'd own, there's roughly $60 of net debt sitting behind it. Debt-to-equity ratio confirms it, coming in at 3.73, meaning total debt is nearly 4 times the size of the company's book equity. This matters enormously for one number everyone loves to highlight: return on equity, or ROE. Vistra's ROE is a stunning 42.96%, which at first glance looks like one of the most profitable businesses around. However, one number changes the entire picture. Because the company's book equity is relatively small, at just $5.49 billion, even a normal amount of profit gets divided across a much smaller base, inflating that ROE figure. Heavy debt, not just business efficiency, is doing a lot of the lifting here. So how efficient is Vistra once you strip out the effect of leverage? That's what return on invested capital, or ROIC, is meant to reveal. Vistra's ROIC comes in at 9.72%. Compare that to the company's weighted average cost of capital, or WACC, which sits at 9.6%. These two numbers are almost identical, which means Vistra is earning only slightly more on its invested capital than what it actually cost the company to raise that capital in the first place. That's a thin margin of real outperformance, even though the headline ROE looked dazzling. But let's not paint an entirely negative picture, because the cash flow story tells a different side of this business. Over the past 12 months, Vistra generated $5.12 billion in operating cash flow. After subtracting capital expenditures of $2.87 billion, the company was still left with free cash flow of $2.26 billion, or $6.72 per share, with a free cash flow margin of 11.74%. That's real cash left over after running and maintaining the business. Here's another pattern worth noticing, though. Vistra's current ratio, which measures its ability to cover short-term bills with short-term assets, sits at 0.97, just under the safety line of 1. Its quick ratio, a stricter version of the same test, is even lower at 0.26, and working capital is actually negative $281 million. At first glance, that looks like a short-term liquidity concern worth keeping an eye on. Now let's talk dividends, because this is where long-term shareholders tend to lean in. Vistra pays an annual dividend of 92 cents per share for a dividend yield of 0.66%. That yield alone might not turn heads, but the company has now grown its dividend for 6 consecutive years in a row, with the most recent increase coming in at 2.01% year over year. And here's the interesting part. The payout ratio, or the share of earnings actually paid out as dividends, is only 15.58%. That's a fairly low number, which suggests there could be room for that dividend to keep climbing without straining the company's earnings. Meanwhile, out in the market, something else has been shifting. Short interest, meaning the number of shares traders have bet against, currently sits at 8.68 million shares, down sharply from 15.92 million shares the previous month. A large chunk of the bearish bets against Vistra have already been closed out. At the same time, the stock's Relative Strength Index, or RSI, a measure of whether a stock is overbought or oversold, sits at 39.48, leaning toward the oversold end of the scale. The stock is all trading below both its 50-day moving average of $153.40 and its 200-day moving average of $160.12. So where does that leave us? On one side, 19 analysts are pointing to a price target of $219.72, representing upside of 58.14% from current levels, alongside forecasts calling for revenue growth of 13.91% and earnings per share growth of 35.76% over the next 3 years. On the other side sits a company carrying serious debt, thin short-term liquidity, and a return on invested capital barely ahead of its cost of capital. One last data point worth mentioning, just to understand how this business actually runs day to day. Vistra generates about $3.01 million in revenue for every single employee, across a workforce of 6,390 people, translating into profits per employee of roughly $317,214. And on the Piotrowski F-score, a 9-point scale that grades overall financial strength, profitability, and efficiency, Vistra lands right in the middle at a score of 5. So here's where the story leaves us. Vistra is a company with eye-catching profitability on paper, real free cash flow generation, a dividend that's grown for 6 straight years, and a wall of analyst optimism pointing toward significant upside. But it's also a company leaning heavily on borrowed money, operating with tight short-term liquidity, and earning a return on capital that's barely above what that capital costs to raise in the first place. Which of these two stories ends up defining Vistra's next chapter? The one written by the analysts and their price targets, or the one written by the balance sheet and its debt? That's a question worth sitting with.